Welcome. I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you our weekly update on the markets and financial planning and some hot topics. So here we are. Today is April 24th, and from last week to today, just to give you a perspective of where we're at with the markets, the Dow Jones is down as of yesterday's close, and yesterday was April 23rd. The Dow Jones was down 6.9%. And as I reflect back between this week and last week it was about the same. So we didn't see that much movement in the Dow Jones.
Laterally.
Yeah.
But it went up and down.
We felt the movement every day. The NASDAQ year to date is down about 13.48. And that doesn't include today, because today the markets are up pretty nicely. But from the last week, and last week the NASDAQ was down 15.55. So we've seen a couple percentages here with the NASDAQ. Is similar with the S&P 500. Year to date, as of yesterday, April 23rd, it was down about 8.60. And the Russell 2000 was down about almost 14%. And once again, both about 2% differences from last week. So this week, it's been interesting. There's been a lot of market movement, and the markets have been every day looking at hearing the news and what's happening with the administration and tariffs and the Fed and Powell, and there's just a lot of stuff, a lot of things that are going on, and the markets have been reacting pretty much daily. And then kind of looking at where the Fed rates odds are for rate cuts, it looks like for May there's potentially not going to be any rate cuts, but the probability of a rate cut in June is now about 60%. Whereas last week it was 72%, so it's come down a little bit.
Well, I'd like to know where those probabilities come from, and I'll tell you why. Because, Powell has said that he wants to wait on Jerome Powell, who's the Federal Reserve Chairman. He wants to wait to see all the effects of what's going on. Yeah. The problem with that approach is that by the time you see it, it's too late to act on it. And that's kind of what he did prior to this, when we had very low interest rates, and he should have raised interest rates.
It was transitory back then, though.
Yeah, he kept saying it was transitory all the way up. So that scares me a little bit, that he says, I want to wait. And when, they should be a little bit proactive if you think that the economy is going to slow down. And to tell you the truth, it hasn't shown that yet. But if it does, if you do think that it's going to slow down for whatever your reasons are, I think that you should be a little preemptive.
Well, and then last week, Vince, you asked me, how many rate cuts do we expect this year? And so this changes, obviously, as well, the information that's out there. But the Reuters, as of April 9th, the traders see 3 Fed cuts in 2025 for about 75 basis points is kind of what we're looking at. But then some other economists and some other reports show potentially 5 rate cuts this year, and that was from investing.com. And once again, that was a couple weeks ago. 2 weeks later, here we are. The markets are fluctuating, and like Steve mentioned, they should be a little more proactive with some of these analysis.
And why even bother to listen to that stuff? Somebody says 5, somebody says 3, somebody says none. Yeah. Well, let's just flip a coin. We'll figure it out.
Well, it does move the market, unfortunately. People will take that into consideration. But anyway.
And the algorithms.
Yeah.
The electronic trading, I think, probably has a bigger effect just listening to some of those reports. That's big money that's moving very fast.
Absolutely.
And,
No, absolutely. In fact, I was thinking about, the market volatility over the past couple of weeks, and Catherine has talked about it. We've talked to her a lot about on this podcast. And, one of the reasons, and again, this is just my own belief, is one of the reasons why I think we've had such heightened market volatility is there's been a lot of excessive leverage that was in the market. And for those that don't know, leverage is simply borrowing capital against an investment expecting a bigger return. And so many multi-billion-dollar, multi-asset hedge funds that are out there invest in currencies, fixed income, and futures contracts. Well, futures contracts are legally binding agreements to buy or sell a specific asset at a predetermined price at a specific date. Well, typically, these investments are very liquid, and their prices don't move significantly up or down. And oftentimes, hedge funds will use these types of investments to hedge their stock portfolio. Well, as a result of liquidity and typically a preset return, hedge funds will often lever these investments, greater than 30%. So they're betting that they're going to get excess returns on a lower return investment. Well, as I mentioned, they don't significantly move up or down until they do. And when they do, a hedge fund, if it's on the wrong side of the trade, of a highly leveraged trade, can lose a lot of money. And recently we saw that happen in the bond market, where a huge amount of money came into the bond market and was buying debt securities. Well, usually when they start buying debt securities, yields come down when prices start to go up. However, the opposite occurred. And we saw that recently, I think it was a couple of weeks ago, Catherine mentioned it, interest rates spiked. Well, at the same time interest rates were spiking, stocks were losing a considerable amount of money because the markets were selling off very aggressively. So hedge funds that are on the wrong side of that levered trade, they can't unwind these heavily leveraged trades. So what they do, they sell their stock portfolios to try to mitigate the losses on the opposite side of their book. Now, I don't know if this has happened to a lot of hedge funds because you never will really know this until 3 or 4 months in the future. But I guarantee you, I was in the hedge fund business, I ran a hedge fund, and we saw this a lot where 2 or 3 months after a big market move, or you can call it a standard deviation event occurred, you will hear that some big hedge fund went out of business. So my advice to anybody listening, don't use leverage. Don't over leverage your portfolio. In fact, I was talking to Greg about this. Not only can it occur in the stock market and the bond market, but in real estate. And you were just giving me an anecdote.
Yeah. I had a buddy who got into real estate a number of years ago and bought one rental house, and that was doing good, getting some cash flow. Then he bought another and another and another, and everything was going great, making some nice income. But when we went into a recession, a lot of people lost their jobs, and they couldn't pay their rent. Yet my friend still had to pay the mortgages to the bank. And so that doesn't end well. So in a sense, he's levered because he has all those mortgages, and he's trying to get in this income from the rents. But when the rents stop coming in, he can't sell the real estate fast enough.
Well, that's essentially what happened in 2007.
Yeah, exactly. That on a very large scale. And I can't even remember. It was either 2007 or this might have been the 2000 recession, I believe, when he actually got in trouble. But people think real estate is solid. You can touch it. It's safe. But if you're over-levered because you owe too much and you lose your job, you can't pay your own mortgage. People lose their houses. So you're right.
It's just one of the, and again, I'm not saying that that's what happened, but it's very typical. And I read somewhere I think it was the Journal, that there were a lot of hedge funds that were on the wrong side of some trades recently.
Yeah,
so.
and when that happens, what happens is people get more scared because they see the stock market going down. And anyone want to know where the fear and greed index is?
Yeah, I was just going to ask you that.
I'm going to guess 25.
Any other guesses?
31.
You're close. It's at 30. And so we're now back into just the normal fear category as opposed to the extreme fear. Remember, it was at 4 3 weeks ago. And then it was at 6, and I think it was at
the teens last week, wasn't it? Yeah.
And now it's at 30. Yeah, you're right. It was like 23 or something, and now it's at 30. So it does mean that the fear is subsiding from where it was. But we talk to clients and other people all the time, and there's still plenty of fear out there. Especially if you're predisposed not to like the administration, it's even more fear. Understandably. It was the same way the other way around in the last administration.
It is funny how many people invest with their political beliefs, and we all have clients on both sides of that spectrum. And until recently, there was everybody did kind of flop. The ones that were all fine are now concerned, and vice versa. So it is interesting, and that's why we try and keep the longer term perspective with investing instead of getting that emotional attachment to it.
And it's going. on what you just said. Jeremy Siegel, who's a real well-known economist, he's also a professor emeritus at Wharton School of Business at the University of Pennsylvania, wrote the book Stocks for the Long Run, very well respected. He was saying that the tariffs, well, first of all, he's saying that, equities will do well in the long run. That's his deal. It's kind of Warren Buffett approach. But he said the tariffs could knock 5 to 7% off of U.S. per capita real income by reducing trade efficiency. So if there are tariffs, there's great reason to believe that the economy will slow. However, right now, it's not showing that yet. In the March labor market, and this is from Value Line, the March labor market data were encouraging. The nation added an estimated 228,000 jobs last month, far exceeding the consensus forecast of 140,000. That's almost twice as much. The unemployment rate ticked up to 4.2%, but it was accompanied by an increase in the labor force participation rate to 62.7, which is an indication that the jobs market is solid. So as of right now, it doesn't look like things are slowing down. What Jeremy Siegel is saying is that if these tariffs go into place, it will slow down. Now, recession, who knows? I'm in the last 3 years, 4 years, the inverted yield curve, the inflation, whatever it is, we've said there's going to be recession. All right. Now, I will say that if the tariffs that Trump first announced were to go into place, there probably would be a worldwide recession. All right. I don't think that's where it's going to end up. All right. And every time the market goes down a lot, Trump seems to backtrack, which is also a problem. Do you know where he really sits? And so the people, especially the people who don't like him, say, this guy doesn't know what he's doing. Even some of the people who voted for him, I'm hearing saying, I'm not sure he knows what he's doing.
Yes, to say you're probably
Okay.
right.
Well, when it's every other day, there's different angle that he's got going on.
Right. But some of the things he says make some sense. He took a lot of grief for calling out Jerome Powell, and I agree with that because he did it publicly. But even Jeremy Siegel was talking about that, and he said that if Jerome Powell remains too hawkish, in other words, he doesn't want to lower rates, despite recent soft inflation readings and evidence that the economy is weakening, then we could be in trouble. Powell has leaned into elevated inflation expectations and tariffs as a risk, brushing aside the clear progress in real-time data. So basically, he's saying that he thinks that Jerome Powell should lower the rates. But when President Trump goes in and says publicly that Jerome Powell, you're an idiot, and you should be doing X, Y, and Z. If I'm the other person, I'm thinking, well, I'm not going to listen to you. Unfortunately, though, it could hurt our entire country. This feud is stupid, in my opinion. And Powell should not just say, well, let's wait to see what happens, because by then it's going to be another 8 to 12 months before whatever policy you put into place actually has an effect. There's a lag effect. Yeah. So I see both sides of the coin here. I'm just hoping, because I say this every time we talk about tariffs. I hate tariffs. All it is a tax. Okay? And I really think what Trump is trying to do is saying, well, we're going to collect a tax on this stuff so that we can pay down our debt, which is the real problem that we have. Our long-term debt is at $37 trillion. $37 trillion. I don't know how far it gets you if you stack up $37 trillion, but I'll bet it goes a long distance. Okay? And if we don't do something to stop spending more than what we earn, or when I say earn, what we take in taxes from people, we will go broke. This is not hard. This is just basic economics.
And they've been kicking that can down the road for
a long time.
Many decades.
Forever. And part of it, I saw another article that says, once we got off the gold standard, because when we had the gold standard, you couldn't print money, you couldn't do more than what our gold actually represented, how much that was worth. Once they got off the gold standard, they started printing money, and they started and that's where the deficits and the debt really started. And that's back in the 1970s, and it just keeps getting worse.
Yeah, so. I think it's interesting that so basically we're doing this deficit spending, and it's worked out pretty well, for our economy over the years. But I hear the European Union, it's all those 27 different countries or whatever, and they've had very strict financial, criteria as far as having debt. But I think they've recently loosened that up, and I think some of the countries are going to start doing this deficit spending over there. Don't know how that really plays out because it's not the way the European Union was drawn up, 30, 40 years ago. So, if one country's, accumulate a lot more debt than someone else, I don't know how that plays out. We're just one country of a bunch of states, so it works for us to a point.
Well, it is interesting. There's been a lot of S&P companies that have reported their first quarter earnings recently. Many of them have been quite good. And they've all talked about tariffs. They've all said there's uncertainty, as Steve mentions, about tariffs all the time. They're all talking about how they want to improve or enhance their supply chains just in case tariffs have an effect on their supply chains, which is a good thing.
Right. And isn't it part of it where they really need the time? Like, you can't just say, we're going to do this, and then you don't give them the time to actually
you
implement and
You're
get...
absolutely correct.
You mean it won't happen in the next 65 days that we've got left?
Well, it's better than no days.
Anyway, but what's kind of interesting, I did see something where the S&P companies that have reported so far, Q1, their earnings are up 5.8% from their last reporting period in January. So again, it's looking back, but the guidance hasn't been that bad. And as I've been saying on this podcast over and over and over to anybody who wants to listen, don't get too conservative. Don't liquidate your equity positions thinking that the market's going to zero, because as Catherine mentioned, over the last 3 days, any good news has a huge impact on this market, and it's driven it straight up. So if you were out of this market, you all of a sudden realize you're trying to play catch up again, and that's not a good thing. And again, where I've said all the time, look to technology, because technology is the rally point for this market. And you saw it over the last 3 days. It wasn't the big conservative staples or railroads or anything. It was technology. So again, find these.
How about the stable railroads?
Anyway, all I'm saying is, be careful on how conservative you try to get, because any good news on tariffs or any good news from companies can lift this market dramatically.
It seems like any news is moving the market, whether it's up or down. Trump comes out and he says something bad about Powell, the market gets killed. Powell comes out and says that he wants to wait to do anything with cutting rates, the market gets killed. Then Trump says, "Well, we're going to, stay," and this isn't in order, but we're going to stay the execution for 90 days. The market rallies like crazy.
No, absolutely. And the thing is, the reason why I'm talking about technology is because the big technology names, and take the top 20 technology names out there, they're incredibly liquid. And so when big investment companies need to put cash to work, they need liquidity. And where do they go? They go to the big liquid companies. So anyway, again, just a caution to the investors out there. If you want to be conservative, that's fine, but don't get out of the stock market completely.
I think being conservative really has many meanings.
That's true. My meaning is a little different from a lot of people.
Well, some people think that getting conservative is going to cash. I think that's not being conservative. I think that's being irrational. Okay, to me, being conservative is maybe balancing the portfolio a little bit, or perhaps getting into high-quality dividend payers, which include some technology.
There's a lot of technology companies, yeah.
But I think if you're in quality, and we say this all the time, if you're in high-quality companies, more than likely most of them will be fine. You're going to have some that don't, and that's always every market. I mean, look at how many companies are gone from the market over the course of many, many years. But some go, are merged with other companies. They change names.
They go private.
They go private. Some go broke. And everything changes. And what you're saying, as far as technology is the king of change.
Oh, yeah.
That some companies that were huge 50 years ago or 30 years ago aren't even around right now. Okay, so you do have to do that. But high quality is what you want, whether it's stocks, bonds, real estate, I don't care what it is, you want high quality.
So now that it's springtime, it's a good time to kind of tidy up your home. And I actually just got my windows cleaned last week.
There
So I'm
you
super
go.
excited. It's
Oh,
really
we did
sparkly.
too.
Did you?
Yeah.
Oh, interesting. See, it's
Yeah.
springtime.
And now I can see outside my windows.
But we thought it would be nice to talk about financial spring cleaning and a couple of key tips to think about now that it's springtime from a financial perspective. One is to maximize your retirement contributions. So if you're still working and funding your retirement plans, making sure that you're maxing those out. There's been a lot of changes each year. There's usually an increase, and so if you're in a retirement account or IRA, we have different types of contributions. It's also a good time to kind of confirm and update your beneficiaries. So I don't know when's the last time you've reviewed that or looked at that, but sometimes there's marriages or kids get older or there's grandkids or perhaps there's an update that you want to make. So yeah, we're happy to share with you what you have on file with us and or make any updates as needed. And then something we do periodically, I actually have a service, so I look at this pretty monthly, but I do think it's important to check your credit report and do a full report, so making sure you do that at least annually if you haven't done that already. And then another item is, which is something that I think gets overlooked occasionally, is organizing and looking at your financial documents. And so if you have those files in your computer, maybe you have some things that are outdated and just kind of deleting or saving things if it's way past due, but just making sure your documents are in order electronically as well. So just a couple tips for now that we're in this springtime and obviously doing a financial checkup or financial plan checkup are always available for that. And like Steve mentioned too, that making sure that you're positioned well with this market.
Yeah, good.
I did do an insurance review.
Did you? Nice.
I did, yeah. For the first time in a long time, I went and had a guy look at my home insurance and earthquake insurance and all that. And what I found was I was so significantly underinsured.
Oh, no. Okay.
Well, I guess part of it was because the building replacement costs have gone from like $200 a square foot. They're now up around $900 a square foot. So,
Well, especially in the San Diego area.
Yeah.
I think
Oh,
I read
yeah.
San Diego is now one of the most expensive real estate markets, if not the most. I can't remember the number, but it's right up there. I'm at the top 5.
Well, it's interesting.
I
I
did
actually
the
heard, because we had that earthquake last week, but we got a little shakeout
that was
here.
fun.
Yeah, that was fun. But
was
then I've
fun.
heard a couple people say, do I have earthquake insurance? So definitely make sure
well,
you
I
check.
do. And
Yeah.
guess what? When you increase your insurance on your house, your earthquake insurance goes up as well. So.
Yeah, we just had our insurance guy, do an evaluation on our house, and luckily it was fine. But this is like a week after my wife forgot the payment on the homeowner's insurance. I'm like, honey, you got to get that done.
Yeah.
And she's always very good about it, but I was thinking, oh my gosh,
There
they're
is a-
dropping people for just
For
anything
anything.
now.
Oh, yeah.
So,
I
I
think
think there is a grace period on insurance. Usually, what is it, 30 days?
Yeah, I'm not
yeah, but
sure
they
if it's-
can drop you. So maybe they give us 30 days, but maybe we don't have insurance at the end of the month. So
Well, yeah, most people do. I didn't hear a lot of a lot of news about the earthquake, but that was one of the stronger ones that we
Here.
felt around here. I think
that was a good one.
I think it was out near
Julian,
which is west of San Diego by about 30 miles?
100 miles,
East.
I think. Yeah, northeast.
It's 100
East of-
miles?
I was surprised.
I'm
I
sorry,
thought it
east.
was maybe it's 60 miles. It was further than that. I thought it was 30 miles, but it's
I
further
thought
out
the
there.
earthquake was because the stock market went down 1,000 points that day. That's what
Double
I thought.
whammy, right?
That's right. We were all
Which
shaken
day?
up a little bit. We were all shaken up a little bit twice. Once with the huge downturn in the market, the other one, our building was swaying, and we're on the 3rd floor. And I was thinking, this is a long way down.
No Elvis in person.
Well, I was kind of thinking, do we run down the stairwell or hang out here and fall down, like you mentioned,
Yeah.
3 stories? I
3-story probably. Yeah.
didn't know what to do, and I noticed nobody else really
I
was
just went to
moving
the
that
doorway.
fast.
I just went to
Oh,
the-
you got to the doorway?
Although in
That or under your
Yeah,
desk?
because if the building falls, you'll be safe.
I don't know. That's what
Doorways and desks.
Yeah.
Get under something.
All right. Well, in the fear and greed index on that one, I was up to about 50. No, actually, I was up to about 70 because I wasn't sure what was going on.
No
Well, you're
shaking.
greedy?
I'm sorry, down to about
There you go.
30.
Okay.
Yeah, you're right. The inverse of that.
You felt really comfortable during the
Yeah,
swing.
well, yeah, why not? We've got a very safe building. I knew you guys would catch me if we fall.
I'll cover you up. I'll protect you.
All right. Well, listen, that wraps it up for this week because we don't have any more gossip to talk about. And we'll see you again next week. Thanks for listening.
Thanks.
Thanks.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.